In August 1992, a man named George Soros made a single bet that broke the Bank of England. He wagered that the British pound was overvalued. The British government said it wasn't. They had the entire weight of the treasury behind them, billions in reserves, the credibility of a G7 nation. Soros won. The pound crashed. Britain lost billions. And one man walked away with over $1 billion in profit. Here's the uncomfortable part. He didn't hack anything. He didn't break any laws. He simply understood something most people don't, that the strength of a currency isn't decided by governments or central banks or economists on television. It's decided by a kind of global consensus that forms in real time, across millions of transactions, and it can turn on you faster than any institution can react. So who actually decides when a currency is weak or strong? The answer is more unsettling than you think. Let's start with what we're told. The official story is simple. A strong currency means your money buys more abroad. Weak means it buys less. The dollar is strong when it takes fewer dollars to buy a euro or a yen. It's weak when you need more. That part is true. But it's not the whole truth, because the question isn't what makes a currency strong or weak, it's who gets to decide. And the answer isn't a person or a committee or a formula, it's a market, a global 24-hour, $5 trillion a day market where currencies are bought and sold every second. No one controls it, no one owns it, and yet it determines the value of every dollar, euro, yen, and rupee in your pocket. This market is called the foreign exchange market, Forex, and it runs on one principle: supply and demand. When more people want dollars, the dollar gets stronger. When fewer people want them, it gets weaker. Sounds fair, sounds logical. But here's the thing: the people buying and selling aren't just travelers exchanging cash at airports. They're hedge funds, central banks, multinational corporations, sovereign wealth funds, algorithmic trading systems executing thousands of trades per second based on patterns most humans will never see. And they're all betting on what they think a currency should be worth, not what it is, what it should be. Let's break down how this actually works. Imagine you're a German car company. You sell 1 million cars in the United States this year. Americans pay you in dollars, but your workers in Germany need euros. So you take those dollars and sell them. You buy euros. That's one transaction. Now multiply that by every export, every import, every business deal across borders, every day, forever. Each transaction is a vote on whether the dollar is worth more or less than the euro at that exact moment. But it's not just businesses. It's investors. If the U.S. economy looks strong, investors buy dollars to invest in American stocks or bonds. That pushes the dollar up. If the economy looks weak, they sell. That pushes it down. It's also central banks. If the Federal Reserve raises interest rates, holding dollars becomes more attractive because you earn more interest. People buy dollars. Dollar strengthens. And it's speculators, people who don't need dollars for trade or investment. They just think the dollar is going to go up or down, and they bet accordingly. All of this happens simultaneously. All of it affects the price. So when someone asks, who decides? The answer is everyone who participates, and no one at all. But there's a twist, because while the market sets the price, central banks and governments can intervene. They can step into the market and buy or sell their own currency to push it in the direction they want. They do this all the time. In 1992, the Bank of England tried to prop up the pound by buying billions of pounds with their foreign reserves. They were trying to convince the market that the pound was worth more than it was. Soros bet against them. He borrowed billions of pounds, sold them, waited for the price to drop, then bought them back cheaper and returned them. The difference was his profit. The Bank of England couldn't keep up. They ran out of ammunition. The pound collapsed. Britain was forced to devalue. Soros didn't decide the pound was weak. The market did. He just saw it before the central bank admitted it. This is the uncomfortable math. Even the most powerful governments are players in the market, not referees, players, and players can lose. Now zoom out, because this isn't just about speculators and central banks. It's about what a weak or strong currency actually does to your life. A strong currency sounds good. Your money buys more. You can travel abroad cheaply. Imports are cheaper. Inflation stays low. But it also makes your exports expensive. expensive. If the dollar is strong, American goods cost more abroad. Foreign buyers go elsewhere. American companies lose sales. Jobs disappear. A weak currency sounds bad. Your money buys less abroad. Travel is expensive. Imports cost more, but your exports become cheaper. Foreign buyers flood in. Manufacturing revives. Jobs come back. So which is better? Depends on who you ask. If you're a consumer who loves cheap electronics and vacations in Europe, you want a strong currency. If you're a factory worker whose job depends on exports, you want a weak one. And here's where it gets political, because governments know this, and they manipulate their currencies accordingly. China, for decades, kept the yuan artificially weak. They intervened in the market constantly, selling yuan and buying dollars to prevent the yuan from rising. Why? Because a weak yuan made Chinese exports irresistible. It fueled their economic rise. The US accused them of currency manipulation, called it cheating. But then the US does the same thing. When the Federal Reserve cuts interest rates to near zero and prints trillions of dollars, it weakens the dollar. That boosts exports. That keeps the economy afloat. They just call it monetary policy. Here's the irony. Everyone wants a weak currency when it helps them, and everyone accuses others of cheating when they do it. There's even a term for this: currency war. When one country weakens its currency, others follow. If Japan weakens the yen to boost exports, South Korea feels pressure to weaken the won. Then China steps in. Then Europe. It becomes a race to the bottom. And at the end of that race, no one really wins. You just end up with inflated prices, distorted markets, and a system that rewards manipulation over productivity. But there's no referee. No one to call foul, because the market is the referee. And the market doesn't care about fairness. It cares about supply and demand. Let's talk about what actually moves the market. Interest rates are the biggest lever. When the Fed raises interest rates, global investors move money into dollars to earn that higher return. Demand for dollars rises. Dollar strengthens. When the Fed cuts rates, the opposite happens. Investors move money elsewhere. Dollar weakens. Then there's inflation. If inflation is high in the US, each dollar buys less. Investors lose confidence. They sell dollars. Dollar weakens. Economic growth matters too. If the US economy is booming, foreign investors want in. They need dollars to invest. Dollar strengthens. Political stability. If a country looks chaotic or risky, investors pull out. Currency weakens. This is why currencies in countries with coups or corruption or debt crises tend to collapse. Trade balances. If a country imports more than it exports, it's selling its own currency to buy foreign goods. That weakens it. And sentiment. Sometimes it's not about fundamentals at all. It's about perception, confidence, fear, rumors. A single headline can move a currency by percentage points in minutes. This is why currency markets are so volatile. They're not just reacting to data, they're reacting to what people think the data means. And people are wrong all the time. So where does that leave us? A currency's strength is a collective hallucination. It's real because we all agree it's real. The moment we stop agreeing, it changes. And that agreement is shaped by thousands of variables: interest rates, inflation, growth, politics, sentiment, speculation, intervention, algorithmic trades, breaking news, Twitter threads, central bank statements, geopolitical tensions. No single entity controls it, but every entity tries to influence it. And the result is a system where the value of your money is decided by forces you can't see, in markets you don't access, by people whose incentives don't align with yours. Governments will tell you they're managing the currency in your best interest. Investors will tell you they're just responding to reality. Economists will tell you it's all rational and efficient. But every so often, someone like George Soros comes along and proves that the whole thing is just a bet, a very large, very consequential bet. And when the bet goes wrong, it's not the speculators who pay the price, it's everyone else.